Standard cost is the predetermined cost assigned to each unit of production. It is based on cost elements, expected material, labor, and overhead expenses. It serves as a benchmark for measuring actual performance, enabling managers to identify variances, streamline operations, and enhance cost efficiency in the production process. Basically, in a simple term, you can understand it is a predetermined cost. Means it is determined beforehand before incurring any cost of production. Standard cost is a predetermined cost which is calculated from management standard of efficient operation and the relevant necessary information. Standard cost is a reasonable cost that should be achieved under a reasonable level of efficiency which a management desires. It involves measuring the cost at a particular level of operation under specified conditions. So basically, it is a predetermined cost which is determined beforehand before incurring the actual cost of production, and it is divided into three kinds of elements, that is material, labor, and overhead expenses. Now, what are the steps involved in standard costing? As you can see, there are many steps involved in standard costing. Establishing the standard cost, determining actual cost, comparison, analyzing the variances, submission of report. Establishing standard cost. Establishing standard cost for each element of cost. Standard cost is determined for each element of cost, and we know what are actually elements of cost, that is material, labor, and overheads. Then after that we determine actual cost. How much actual cost has been incurred? After that we compare standard cost with the actual cost, and after comparison we derive the variances, and and classify them into favorable and unfavorable variances. First of all, we establish the standard cost, determine actual cost, compare the cost, and after that we determine the variances and analyze whether the variances have been favorable variances or unfavorable variances. And on the basis of that, we submit the report. Now, suppose if I say numerically, I will explain it to you what actually standard cost is and what are the variances. Suppose, as per my estimate, as per certain technical reports and based on certain calculation by the experts, it has been derived the standard cost of material will be 500 rupees. But when actual production was carried on, the cost incurred was of 400 rupees. So this 100 rupees is a variance. So I think you must have understood what actually standard cost is and what are the steps involved in this standard cost. Standard cost was 500, actual cost incurred was rupees 400, and the variance which was arrived after deducting standard cost from the after deducting actual cost from the standard cost is rupees 100. So this is the variance which has arisen. So these are the following steps, and after these 100 rupees variance will be presented in a report, and it will be analyzed that why this difference has been occurring. Are we compromising with the quality of a material, or the management or the supervisor has been so efficient that has actually saved 100 rupees while incurring the cost on the raw material used for the production. Now moving on further. Prerequisition for installation of standard costing in a organization. So what are the pre-requirements when you want to establish any standard cost in the organization? First is establishing cost center. The area of operation of a business is to be divided into various cost centers. This helps in fixing standards for various cost centers. The actual costs are collected in relation to each cost center. Deviations between standard cost and actual cost are ascertained for each cost center. This helps in establishing responsibility for adverse deviations. Person in charge of a cost center knows his responsibility. So first task for establishing any sort of standard costing system, there should be established cost center, whether it's a revenue center, investment center, because each cost center will be having a certain person who will be heading the responsibility, and that person can be uh, connected if there certain sort of variances are occurring in case of a standard costing system. Degree of standard. Standard should be scientifically calculated, a standard which is practically useful to be established. It is not like that without any calculation we are establishing certain standards. These standards need to be scientifically calculated. Next is period. Period for use of standard should be clearly fixed and a suitable standard should be selected. Next is level of efficiency. The level of efficiency selected for fixing standards should be attainable with a reasonable standard of efficiency. Fixing a too high level of efficiency cannot be achieved and it will lead to frustration. So any sort of benchmark or any sort of level of efficiency which has been set by the organization, that must be practical and must be easy to achieve. If we are setting too much high standards which is not easy to achieve, that it may lead to lot of demotivation and frustration among the employees. Volume of production. Fixed overhead standards will vary when volume of production varies. So it is necessary to estimate a volume of production that can be achieved. Expected sales volume and available capacity should be considered for fixing volume of production. Next is classification of accounts. So standard costing is established for there are various types of standard costing, and expenses are to be grouped under proper classification and codes are to be assigned. This helps in easy collection of actual cost and compare it with standard cost for determining deviations. Next is difference between standard cost and estimated cost. Students usually get confused because if you see verbal point of view, these both terms have near about have these both terms are specifying the same meaning, but if we see scientifically and technically, these both of these terms are very different from each other. Standard costs are planned costs that are determined by technical experts after considering levels of efficiency and production by using scientific and engineering methods. Estimated costs are determined by taking into consideration the historical data as the basis and adjusting them to future trends. Basically, suppose if I say in a simple terms, estimated cost say what the cost will be, but standard cost say what the cost should be. It does not aim at cost control. Estimated cost does not control the cost, but standard cost system is established with the aim of controlling the cost. Next is in case of estimated cost, the basic past experience and future changes are necessary for determining the estimated cost. But in a standard cost, they are established by the engineering and production department. For example, if I say it is possible there could be rain in the morning tomorrow because there is lot of cloudy system outside, and there is lot of there has been lot of rain in previous days, and there are chances that it can continue to rain for another 4 to 5 days. So these are just estimates I am making by seeing my past changes and by seeing weather conditions and by seeing some experiences, by analyzing some experiences. This is just an estimation. But in case of standard costing, the cost is calculated in a pure scientific and technical manner by engineering and production department. Estimated costs are not entered into books of accounts, but standard costs are entered into books of accounts. Estimated cost may be fixed for a business whole or division. Estimated cost can be for a business, it can be for a department or something. But standard cost is fixed for each and every element of cost. Next is, if there is certain deviation from estimated cost, you cannot fix the responsibility to any person. But in case of standard cost, if there is certain deviation, surely we can fix the responsibility. So this was the difference between standard cost and estimated cost. Next is standard cost and budgetary control. Standard costing and budgetary control are both cost management tools used in accounting and finance. Standard costing is a method of setting predetermined cost for products or services, while budgetary control is a system of planning and controlling operations by comparing actual cost to budgeted results. Budgets are prepared for both cost and revenue, but standard cost is prepared for cost only. Budgets, it is prepared for as a business as a whole or part of an undertaking or department, but standard costing is prepared only for the elements of the cost. Budgets are based on estimated cost and revenues based on past experiences. But in case of standard costing, it is a scientific estimation of what the cost should be. In case of budget, budgets are prepared for a specific period, but in case of standards, cost once established may be used for a long period of time if operating activities remain same. Budgets are basically the expressions of business policy and monetary terms or quantitative terms for the organization. But in case of standard costing, it is a predetermination of cost on the scientific basis. Budgets are not part of books of accounts, but standard costing is a part of books of accounts. What are the advantages of standard cost? First is cost control. Standard costing is an effective tool in the hands of management for the purpose of a cost control. Predetermined standard costs are compared with actual cost and remedial steps are taken in case of substantial adverse variations in cost. So predetermined costs are compared with the actual cost and remedial actions are taken for the variances which have arisen. Measurement of efficiency. Standards are the benchmark for evaluating individual performance. It helps to identify and measure the efficiency of individuals. Incentives to personnel. Standard costings helps to identify and measure the efficiency of individuals. It helps to introduce incentive schemes to those who achieve higher efficiency. Fixing responsibility. Standard cost is a predetermined cost, and when the things are predetermined, it is helpful in fixing the responsibility of any sort of deviation or any sort of inefficiency which has arisen. Utilization of production facilities. Standard costs help in standardization and effective utilization of production facilities. Next is useful for planning and budgeting. Standard costing helps in introducing budgetary control. It also helps in preparing future plans. Next is motivation to employees. Setting standards leads to consulting and seeking cooperation of people from various departments. It creates cost consciousness among people. It motivates the employees in achieving these standards. Next is disadvantages of standard costing. As we know, it is a very scientific method for calculation of cost. So we can say it is a very costly system when it comes to the installation of a standard costing system. Difficulty in setting standards in an industry where different type of people of different nature are working, it is very difficult to set standards in case of standard costing method. When changings are there in a business condition, when business conditions are dynamic and subject to various kind of changes, then standard costing may not be useful in such kind of changing business conditions. Analysis of variance suitability, it may be suitable for industries where work done are of repetitive nature, but it is more difficult to introduce in industries where work carried out is of non-repetitive nature. Analysis of variances. There is a great difficulty in classifying variations into controllable and non-controllable variances. Next is rigidity. Standards once set are treated as benchmark for comparing actual performance. Over a period of time, standards may become rigid and may demand changes, but if it is not done so, then rigidity in the system of standard costing system may arise, and it may be not be suitable when operating conditions are changing. Variance analysis. The difference between standard cost and comparable actual cost incurred during the period. In a simple terms, what we have discussed in a numerical example, that what are variances, difference between standard cost and actual cost is known as variances. Now, what are favorable variances and unfavorable variances? Favorable variance, there can be different types of variances, and on the basis of impact on profit, on the basis of as you can see, it can be on the basis of controllability, on the basis of elements of cost. Now, favorable variances. Favorable variance is actual cost is less than the standard cost. It has favorable impact of on profit. Actual cost, standard cost, actual cost is less than standard cost. So in this case, actual cost is less than the standard cost, so it will be a favorable variance. But in case this situation is vice versa, suppose standard cost is 400 and actual cost is 500. So variance will be again 100, but in this case the situation is vice versa. This is a favorable variance and this is a unfavorable variance. So we basically write U in when it is case of unfavorable variance. So here standard cost, actual cost is less than the standard cost and variance arise of rupees 100, that is positive. It is has a positive impact on the profitability of the organization, so it will be a favorable variance. But in case of standard cost where actual cost is more than the standard cost, so this variance will be unfavorable variance because it will be having a negative impact on the profitability of the concern, because the concern has actually has a, expectations of a low cost, but actual production has been carried out, it was find out that the actual cost was more than the standard cost, so it will be having a negative impact on the profitability of the concern. Now, moving on further, based on controllability. Based on controllability, there are two kinds of variances, that is controllable variance and uncontrollable variance. Controllable variance: when an individual working in a company is made responsible for a variance, it is called controllable variance. Controllable variances are caused by factors internal to the organization. Means, suppose the cost incurs, there has been certain unfavorable variances. There has been a variances arisen, and where actually the responsibility of those variance can be fixed on the employees of the organization, and we can say because of their inefficiency certain variances have arisen. So in that case it is called controllable variance. You can control, you can fix the responsibility of variance which has arisen. But in case of uncontrollable variance, the situation has been, variances have been arising due to the factors external to the organization. No individual within an organization is responsible for these variances. Next is based on elements of cost. As we have already studied, there are three elements of cost: direct material cost, direct labor cost, and overhead variances. So in that case, we have three kinds of variances, that is material cost variance, material labor variance, and overhead variance. Now we will study these kind of variances one by one. Material cost variance: it is the difference between the standard cost of direct material specified for the output achieved and the actual cost of direct material used. This difference in material cost may be partly due to the difference in the usage of raw materials and partly due to the differences in prices. So material cost variance is a variance where variances has arisen due to difference in cost of materials, which formula for calculating material cost variance is standard price into standard quantity minus actual quantity into actual price. Next is material price variance, which is the difference between calculated forecast of how much a material cost and how much that material cost during actual use. Simply, it is specified in the name itself, the variances which have been arisen due to differences in the price of the standard price and the actual price. So material price variance is calculated on the basis of actual quantity, standard price minus actual price. Material usage variance is basically is associated with the standard costing system, and it is there because of the difference in the quantity of material used. This variance result when the actual quantity of material used is different from the quantity of materials that should have been used to make a good output, and the formula for calculating material usage variance is equal to standard price, that into standard quantity minus actual quantity. Next is material mix variance: actual proportion minus revised standard proportion of actual input into standard price, and this revised actual quantity is calculated by the formula actual mix into standard mix ratio. Basically, material mix variance is when we are having more than one material and their mixing change is changed, and their standard mix and actual mix is changed and where variance has arisen, that particular variance is known as material mix variance. For example, what we say, you are making a tea for two guests for your in your house. You are having a certain portion of tea leaves, you have certain portion of milk, you have certain portion of water and sugar for two people. Now the scenario has changed. You have now suddenly two more guests have arrived in your house. So certainly what will happen, the proportion will of tea, milk and sugar and water will change with the arrival of two more guests. Previously you were making tea for two people, now you are making tea for four people, and with this additional two people have with the addition of these two people, the mix of your tea ingredients has totally changed and it has increased. So this kind of change in the proportion of material from standard mix to actual mix give a rise to material mix variance. Next is material yield variance. Material yield variance explains the remaining portion of the total material quantity variance. It is that portion of material usage variance which is due to the difference between the actual yield obtained and the standard yield specified in terms of actual output. In other words, yield variance occurs when the output of the final product does not correspond with the output that could have been obtained by using the actual inputs. So these are the theoretical aspects we have gone through in case of variances. We can understand them more clearly with the help of some practical problems. You have one question in front of you. The standard price of material is rupees 15 per unit and actual price is 13.50 per unit. Now, without thinking anything, we know standard price is 15 per unit and actual price is 13.50 per unit. Now what they are saying, material purchased amounted to 600 units and closing stock of material is 50 units. Standard quantity is 500. We have standard quantity of 500 units. Now we have to calculate the material cost variance. Material cost variance, we all know standard quantity into standard price minus actual quantity into actual price. Now we all have been specified in the question, but nothing has been specified as regarding the actual quantity. You can see material purchased amounted to 600 units and closing stock is 50 units. So it is clearly understood from the language that previously 600 units were there in the starting and after that closing stock of material is 50 units. So 600 minus 50 is the actual quantity of material which has been utilized, which comes out to be the figure of 550. Now we can input these values in the formula. Standard quantity is 500 standard quantity. Material cost we know is standard quantity into standard price. Standard quantity is 500 multiplied by 15 and minus actual quantity is 550 multiplied by 13.50. That is 7500. It has already calculated, so no problem. Minus 7425, which will give you the value of 75, which is again positive, and we will write in the bracket favorable. Next is material price variance. Material price variance. What is the formula for material price variance? Let's look back. It is standard price into actual quantity minus actual price into actual quantity. So standard price is what we will take actual quantity standard price minus actual price. Actual quantity, we know the formula is actual quantity standard price minus actual price. We know what is actual quantity. Oh, this is taking in a formula. No problem, we will write separately so that there is no calculation mistake. Actual quantity standard price minus actual price. Actual quantity is 550. Standard price is 15 minus 13.50. So it will, the value will come I'm doing it for you. It is 825 favorable. 825 favorable. Next is material usage variance. The formula for material usage variance is material purchased amounted to 600 units and closing stock of materials 50 units. Standard quantity is 500 units. Compute material variances. In a question, first we will copy the values. Standard price, it is given 15 rupees. Actual price is given 13.50. Standard quantity is given 500 units, and actual quantity we have calculated after deducting 50 units, that is closing stock materials from the material purchase, that is 550. Now in this question, it is to be noted there is only one material used in the manufacturing of product. Like if you have been given material A, material B and material C, there are 2 to 3 materials have been specified that are used in making a complete product. So definitely we will go for material mix variance also. But in this question, nothing has been specified. There is only one material which has been used, so we will calculate in these kind of questions, we calculate only three variances, that is material cost variance, material price variance and material usage variance. So material cost variance formula is standard quantity into standard price minus actual quantity into actual price. We will put the values we will put all these values in a given formula, and after calculation we will be getting a value of 75, which is positive. And if we are getting positive variance, we will write favorable variance. We see it as a favorable variance, so we will write in the bracket 75 is a favorable variance. Next is material price variance. Formula is actual quantity into standard price minus actual price. Standard price is given 15, actual price is given 13.50, actual quantity is 550. So we will input all these values in the formula and we will be getting 825 as a favorable value, as a positive value. Next is material usage variance. Material usage variance is standard price into standard quantity minus actual quantity. Again, we know all the values, and after putting these values in a formula, we will be getting 750 adverse, that is minus value. So we have two favorable and one unfavorable value. This is one very interesting thing to check if we have calculated the correct variance or not. We have one equation, this is called material cost variance is equal to material price variance plus material usage variance. Material cost variance, we all know it is 75 favorable, and it must be equal to material price variance is 825 plus 750, which is minus value. Now if you will solve this value, let me solve it for you. Eight 25 minus 750, it will give you 75 as a calculated value. So 75, uh, just a second, let me make some changes, is equal to this. Okay, so 75 is equal to 75. This is a minus value. Put it like this so it can be more clear while you're going through the question. So this equation, material cost variance is equal to material price variance plus material usage variance, will help you to understand whether you have solved the question correctly or not. So this was all about material variances. As I have told you before, in this particular question, only one kind of material is used. So we will calculate only three variances: material cost variance, material price variance, and material usage variance. But there are questions in which two or three kind of materials are used in making the final product. That's why in that case we calculate all five types of variances. I hope we have first we have studied its theoretical aspects. Now we have covered the same theoretical aspect with the help of certain numericals. So I hope you are clear with how to calculate the variances. Thank you so much for watching.